Dear students, welcome to Swayam Shikshaa. Now, today we are coming up with the fourth theme, and as students have requested for better concepts, so we are continuing this series. And this theme basically, I'm naming it as banks regulation. And banking regulation, of course, it becomes very difficult to cover banking regulation in one theme. But today, what we will do is we'll first see what were the important questions that have come up in the prelims, and then what kind of approach can we have for that this particular area, and whatever is in news that can be expected in UPSC. This is also something which we have to understand. Now, moving forward, if we can see here, this was something related to the BESL. So when we talk about BESL norms or regulations, okay, so there was one question on BESL regulation or BESL 3. So they did not ask any deep questions on BESL. It was something like a very simple question. But what we should understand is we'll go a little deeper into understanding some terms and terminologies which can be asked in the exam. Okay, so BESL 3 accord often seen in news. This was one question. Then there was one question like this about capital adequacy ratio. And this capital adequacy ratio, how is it important for the banking system, etc. And then with respect to capital infusion into banks. So all these three we can put it into one category, that is about capital infusion. So why there is a need for capital infusion? Why should government infuse capital, etc.? Okay, so then comes up intercreditor agreement. This is about it was in news whether it is Project Shashak, there was a question, or intercreditor agreement, or it can be S4A scheme for sustainable structuring of stressed assets, etc. All these are related to stressed assets. So banking regulation becomes very important even now, because there are many questions that come in this particular area along with banks, board, bureau, etc. So now what we will try to understand is when we talk about banks regulation, okay, so why the banks have to be regulated in the first place is one important aspect is NPAs. Now, what we observe is these NPAs have been increasing mainly between 2011 to 16. NPA is non-performing asset. So before a particular loan becomes an NPA, RBI has also come up with something called as special mention account, SMA, special mention account. So SMA 0 is there, SMA 1 categorization is there, and you also have SMA 2 categorization, SMA 2. So suppose the loan remains stressed for 1 to 30 days, that is, there's no principal nor interest payment. From 31 to 60 days, there is no principal nor interest payment. We call it as SMA 1. And from 61 to 90 days, there is no interest payment. Then we call it as SMA 2. Now, the understanding here is once it crosses 90 days, the loan turns out to become an NPA. Now, many a times these NPAs, there are again categorizations in NPA also. For example, NPAs can be categorized as substandard, okay, doubtful, and we also have something like the loss making. So this is a categorization of NPA. So loss making is something like when I say, the chances of getting back the loan becomes highly impossible, but still it remains on the balance sheet. It is not being removed from the balance sheet of the banks. Okay, so substandard, basically for 12 months there is no payment of interest nor a principal amount. So like this, there is a lot of categorization. But what we should understand, how is UPSC asking questions? Okay, so the need for regulation has become important. And one important area, of course, is this area of BESL guidelines. Now, these guidelines, when we say these guidelines are not given by RBI, but RBI in India, basically, when I say BESL norm is something which we follow. Okay, so norm is something like there's nothing like a binding kind of thing. It is only a norm, but still we follow because RBI has asked the banks to follow. So when I use the word BESL, so these BESL guidelines related to banking are given by BESL Committee on Banking Supervision. We call it as BCBS. So there was one BESL Accord which came up in 1988. Okay, and this BESL Accord in 1988 was very particular with respect to giving some guidelines to all the banking systems across the globe, not just India, it is across the globe. So these guidelines are given to the central banks basically. And central banks ask Indian banks also to follow certain guidelines. So why is it important? Because banks are the backbone of the economy. And if there is some problem with the banking system, for example, in 2008, there was subprime crisis in US and big banks like Lehman Brothers got collapsed. It can affect the economy on a wider scale. So based on that logic, since there was subprime crisis, in spite of there being Basel 2. So for example, now this Basel 1 was the first one. Okay, and this Basel 1 was mainly focused on the handling the capital risk, or it was mainly taking care of something like an aspect related to the capital adequacy ratios, or we call it as the capital risk. And what this particular Basel 1 was saying, Basel 1 says the total capital which the bank is holding. Okay, so this is something which is bank's own funds. Okay, so the total capital which the bank is holding to the risk weighted asset here, when I say risk weighted asset, it is basically the loans are asset for the bank. So each loan has a different weightage. So this risk weightage is different for a personal loan, which is given without a collateral security. So the weightage will be higher. The risk weightage will be higher. But suppose there's a loan with a collateral security, then the risk weightage will be lower. So this risk weightage also differs from every loan. Now this risk weighted loans in the denominator, and you're taking the total capital on the numerator. Now what Basel 1 says is this should be something like 8%. RBI guidelines are a little different. RBI says you have to maintain 9%. So when I take the risk weightage together in the denominator, that means let's say 100 crore loan, the risk weightage is 0.5, another 100 crore, the risk weightage is 0.75. It varies based on the type of the loan. So that risk weightage I'm taking in the denominator. And overall, if I have to give 100 rupees loan, the bank needs to have a capital of at least 8 rupees. This capital is not deposits, it's bank's money. Deposits are not bank's money, deposits are public's money. So this is one understanding. So it's bank's own capital. So this total capital to the risk weighted asset should be 8%. Now the question comes up, why this total capital can be divided into, one is the tier 1 capital, which is the good capital which the bank is holding, and another one is the tier 2 capital. This becomes important. Why this becomes important? Because tier 1 capital is the liquid capital, we call it as, or the good capital. It mainly has the profits of the bank, okay, and it has the equity, regular equity, not the preferential equity, the regular equity of the shares. And this is seen as the good capital because the bank's operation need not be stopped, and you can use this capital very easily. But tier 2 capital is seen as not so liquid because it has some preferential shares. It also has some profits or the earnings of the bank which cannot be displayed on the balance sheet. So these are called as something that is not clearly visible on the balance sheet. Okay. Then it also has something called as a subordinate debt. Subordinate debt is something which is taken care of after all the debt is taken care of. So it is not so liquid. So these are the entities under the tier 2. Now what becomes important is in the Basel 1, there is no specification of tier 1, how much tier 1 should be, how much liquid capital should be there. It only gives a capital aspect like the overall capital should be 8%. RBI says maintain 9. And Basel 1 only takes one risk. In this risk weightage also, it is only taking one risk, which we call it as the credit risk or the loan risk. It does not take other risks like the operation risk. The bank has market risk. These things are not considered in the Basel 1. In the Basel 2 guidelines, it has come up with a supervisory approach where the capital adequacy ratio, though it remains at same 8%, the important aspect in the Basel 2 guidelines is it takes all the three types of risks in the denominator, which includes the market risk, it includes the credit risk, it also includes uh, the operations risk. So this is the basic difference between the Basel 1 and Basel 2. In spite of there being Basel 2, there was subprime crisis in US in 2008, and that is the reason they've come up with Basel 3 guidelines. So India basically adopted Basel 1 in 1999, and Basel 2 guidelines came up in June 2004. And in spite of there being Basel 2, there was subprime crisis in US in 2008. And that is the reason Basel 3 guidelines have come up. So Basel 3 is a more structured format. It not only takes care of these capital adequacy ratios, but also it takes into consideration other buffers like the capital conservation buffer or counter-cyclical buffer, etc., or GSIBs. I will take up a separate video on Basel 3 because Basel 3 will be too much in this discussion. But what we should understand is these Basel guidelines are mainly focused on making the banking system stronger. And RBI's guidelines were even more better off than the Basel guidelines. So this is one good thing. The RBI says maintain more than what the Basel guidelines are saying. And in the recent past, Basel has also appreciated RBI that your guidelines are far better, especially with respect to large exposure framework. Now, this can be a question in UPSC because large exposure framework is in news. Of course, last year, this large exposure framework in 1819 basically has come up with NBFCs. So there was NBFC crisis. So we call it as the upper layer NBFCs, and these are high risk NBFCs. There is always risk associated, non-banking financial companies. So how will RBI define large exposure framework? Now RBI was appreciated that by the Basel saying that your large exposure framework guidelines are very good, in fact better than the Basel guidelines. And that is the reason LEF is in news. So there can be a small question being asked like, what is this large exposure framework according to RBI? And what is this related to, in fact? Okay, so now here what we should understand is this large exposure framework. Okay, so for example, there is one particular firm. Okay, or there are a group of connected firms like Adani group of companies. These are connected firms. Now, a bank, let's say there's a bank, this X bank has given some loan to this single entity, or it could have given loan to these group of connected entities as well. Now, the logic is if this particular bank X is giving a loan to one single entity or a group of connected entities I've drawn here, and if this loan exposure is more than 10%. It is more than 10%. That is, loan exposure is 10% and above. If it is 10 and 10 and above, 10% of what? It is 10% of the bank's tier 1 capital. Let's say the bank's good capital, tier 1 capital is 100 rupees. And the bank is giving 10 rupees and more than 10 rupees loan to one single entity, bank or NBFC, to one single entity or a group of connected firms. Let's say it's group of Adani companies, group of connected firms. Then we can call it as large exposure. That there's a large exposure for this NBFC. X is, let's say, NBFC or a bank. There's a large exposure. It has exposed itself in terms of its loan crossing 10% or more than 10%, more than 10% of its good capital. What is that good capital? Tier 1 capital, tier 1 capital. In that logic, uh, you call it as, yes, there's a large exposure framework, or this loan, there's a large exposure for this particular bank with respect to this particular firm or connected firms. The risk is high because a group of connected firms, if they collapse, the risk for the bank is going to increase. So in this context, we should understand that yes, large exposure framework can put in some pressure. Now, what RBI guidelines were saying, when you're giving such loans to these connected group of companies, it should not be more than 20%, not more than 20% of your tier 1 capital. In exceptional cases, based on the risk profile, it can go up to 25. It will be treated as large exposure framework when you cross 10, and there is a upper limit of 20. Exceptional cases, they can give a 5% leeway. That means you can have up to 25. Okay. If it's an infrastructure firm, if you're giving loans to some infrastructure, group of infrastructure companies, let's say there's a group of Adani, group of companies, infrastructure companies, so it can go up to 30. Exceptional is you can go up to 30. Now, when I say tier 1 capital can be the best capital which the bank is holding. It can be in the form of the profits, the retained earnings. It can be in the form of the equity, or it can be something like the additional tier 1 bonds or 81 bonds. Now, of course, 81 bonds, separate discussion I will do, or there are previous videos done by me on 81 bonds. You can go refer to this 81 bonds. So this 81 bonds will helps in bringing in more good capital. Now the question comes up in this regulation, banks regulation, that the total capital is not sufficient. Then capital infusion will be there. So this capital infusion, it can be infused by government's budget. Government is pumping in capital. Government is buying some equity in the bank, or government is pushing in money. It can be through government means also, capital infusion. So government does capital infusion through its budget, or bank can infuse it by issuing 81 bonds or additional tier 1 bonds, which will be our next discussion, a separate video. Or the old video is there, 2018-19, you can go refer back to 81 bonds. Now, UPSC was asking one question was asked in 2018, like 81, sorry, the capital infusion, the government capital infusion, was it continuously increasing? Now, always remember in 2016, government also came up with IBC. So these are basically trend-based questions. So you have to be intelligent enough. You can't remember. So I have put some graph here. The graph clearly shows that, if you see this red line there, capital infusion was not increasing. It has increased in 14-15, again in 16-17 it has reduced. So you can see this red one going up, and then so there is no trend of increase. So what we should understand is government has to maintain its FDs and all well, fiscal deficit. So government cannot keep on increasing its capital infusion into banks. So there should be other ways banks have to manage it. So based on that logic also, we can mark such questions, but you cannot definitely remember everything. Okay, so now if we go to these questions once, let's try to observe these questions. Okay, so here see two questions we will see here. Suppose there's this question: Basel III Accord often seen in news seeks to. Now this was a very simple banking sector's ability to deal with financial and economic stress. So it's a straightforward, if you know it is related to banks. But Basel III guidelines deal with capital adequacy ratios and capital conservation buffer, okay, and special buffers and globally systematically important banks, leverage ratios, etc. So this I will do a separate video, because the video becomes too longer, it becomes too boring for you. So this was one question. Now there's one more question here. This was another UPSC question only. It is related to capital adequacy ratio specifically. It is the amount that banks have to maintain in the form of their own funds. Yes. It is not people's money. It's banks' own funds. It can be in the tier 1 form or tier 2. The best capital is tier 1. In tier 1, what is there? It is, we have discussed. CR has decided by each. No, it is not decided by the bank. Basically, Basel guidelines decide CAR, capital adequacy ratio. RBI will say you maintain 9. You maintain 9 Indian banks, not 8, which the Basel is saying you maintain 9. So who is saying that? Is RBI, not the bank here. Okay, so this is what we should understand. Once that is clear, the answer should be 1 only. Very simple question here. So we'll try to observe this one more third question, the final question here. With reference to the governance of public sector banking, consider the following. The capital infusion into public sector banks by the government has steadily increased in the last decade. Now, this I've shown you that graph. It shows no. And there should be a logic in answering such questions. You can't remember everything. That's very important. And to put the public sector banks in order, the merger of associate banks with the parent bank. Yes, this is true. So the C is the answer here, because this is true and this is the wrong statement. So very simple questions keep coming, but we should know what the term is. We should know what the concept is. Okay, I hope the video will give you definitely some tips for answering questions like this, and I'll come up with continuation of this video in a separate theme, or I'll do the continuation of regulation theme. Please do subscribe and please do share our videos. And my students have commented that they want more of such videos. They're writing mails to me, and I'm very happy about it. And therefore, we'll put in a lot of effort. Please do comment if you like the video, so that I'll get to know whether you're following. And please do comment on whatever you want specifically also. And you can also comment on something like, yes, these videos are really helpful, so that it gives me a booster. And I'll be there till your prelims coming up with such videos which will give you some 5 additional marks which will change your life. And I hope I'm adding value to your preparation. Signing off. Thank you.